Today's presentation is called 10 Years to Go because I want us to focus on a pending retirement, but more importantly, pending financial independence. And the reason I call it financial independence instead of retirement is, of course, because this is something that I want people of all ages to be working towards so that you live a life that is completely independent of any particular job, any particular geography, and any particular partner. This is one of my biggest goals for all of us. The important information about this seminar is that, of course, this is not specialized investing advice, as I already said. The most important part of this is that this is information that's relevant today in March of 2026. And if there are changes to tax law, if there are changes to the market conditions, any of those things, then this would not be relevant in the future. But I just want you to double check the contribution limits I talk about, check in that the laws that I talk about are still relevant no matter when you're watching this video. The second slide of disclosures is all about results to investments that we may talk about. And just a reminder that any investments that we discuss are for explanation purposes or illustration. They are not recommendations for any particular stock or mutual fund or exchange traded fund. None of that. It's just, again, designed for general information. And if you have questions about any particular stock or investment component, please speak with your financial advisor. So who am I? I am Kacie Swartz. I am the co-owner and managing partner of Blackbarn Financial. I am a certified investment management analyst, which is a designation focused on understanding the insides of pooled investment products like a mutual fund or an exchange traded fund, something where there's a collection of stocks or a collection of bonds or a mix, and then comparing them to each other. So it helps me understand the different mutual funds and how to evaluate them better. It also is designed to be that voice of reason and guidance when I'm advising foundations and nonprofits. So if there's an endowment, if there is a nonprofit, if there's a committee, somebody that's trying to do good work for a greater body, I'm supposed to be able to advise those folks because of the CIMA designation. It gives me a little deeper education on that topic. The big one there, the Certified Financial Planner, designation, just because I am re-recording this, I have a few extra minutes to tell you. It is one of the things that I am the most proud of in my life, but also I'm the biggest advocate for other people pursuing, because if anybody is interested in the financial advising career, the CFP is one of the gold standards designations for this career, but also it is the broadest education component. When you are sitting for your certified financial planner designation, you have to prove that you are well versed in retirement laws, and that's like the different retirement plans. You have to understand investments, you have to understand taxes, you have to understand insurance, you have to understand how all of these things work together, and you have to have a certain number of experience hours before you can hold yourself out as a CFP professional, and you have to maintain these designations with continuing education, which I'm not bragging about all of that. I just want you to know that when you see folks out in the wild who are holding a CFP designation, that means that they put a lot of work into it and they are held to a pretty high standard by a couple of disciplinary boards to make sure that they're doing the right stuff. So FYI. Okay, getting into the actual presentation here at minute 6.57. I want to remind folks that when I talk about retirement, I'm talking about financial independence, because The modern version of retirement is very fluid, and it's not sitting on a Cracker Barrel front porch. It's not necessarily working to 65 for one company and retiring with a gold watch. These things just don't happen anymore. If they ever did, that may just be a Hollywood construct. But what I want to really focus on is getting you to the point where you have what I call FU money. Everybody knows what this is. It's the FU that makes you feel like you could quit your job if you are not happy there, or God forbid you lose your job. You're not totally out of luck because you have resources at your disposal and you have enough confidence in those resources to know that you're going to be okay. And maybe it means that you never work again. Maybe it means you quit a high stress job and you move into something that's a little more in line with your values or with your work life balance. Whatever it might be, I want you all to have that experience because it's a really amazing feeling. So, what I want to talk about today is how do you get there? Well, the first step is you need to know what you're actually spending. This is a list of a few of the budget apps or strategies that are out there. One of the key ones that I used to talk about was mint.com. Mint.com no longer exists. I've heard good things about Monarch Money. I've never actually used it myself. I have been a You Need a Budget girl since 2014. I use it as a tracking software because I don't believe in setting budgets and then restricting myself into budgets. I find that to be the same as when I try and restrict myself to like a diet. It makes me feel hostile and I don't do well with it. I think some personality types might be different, but in general, this is the feedback I get from a lot of folks that setting a restrictive budget is never something that they respond well to. But I do love the idea of tracking your spending. And that's why Excel is such a great fit. And I say Excel, you say Google Sheet. It doesn't matter. But one of the best things that I love about that is that you can see what are the big categories where you're spending the most, and they may not be what you thought they were. So, for example, if I have a line item in my budget for let's say new clothes, for example. And I think, you know what, new clothes, probably $200 a month, let's say. And then I look at the spending because I pull my credit card receipts from 2025, which they have those year end summary reports. Those are fantastic. If you've never pulled one of those on your credit card website and probably your debit card website, RBFCU, where I bank, sidebar about this, but anyway, the RBFCU reports, they don't have as clean of a transaction list. You have to kind of go through statement by statement. It's not my favorite, but I'm sure there's other banks that make it easier. And credit card companies, they all make it really easy. So you can see all of that stuff from last year. And then my point is that when I have this $200 clothing budget, what I find is I don't spend $200 on clothes. I buy cheap clothes for my kids. I do a lot of like thread up consignment stuff or clothes rentals off the internet, and it doesn't really add up that way. But what I didn't realize was I was spending way more than I thought I was, but it's all going to things like the kids' gymnastics nonsense, like multiple classes, or like they wanted a new leotard or whatever's going on there. Who knows? But my point is, it just helps you know your budget better. And this is useful for what's the future going to look like because those kids are not going to be in gymnastics when I'm in retirement, God willing, right? Okay, the work backwards of it all. So, what we can do if you don't know what you're spending and you don't know your budget, you can take your total salary income. And if you're in a two-person household, like a two earner household, you need to do this with both people. But let's just make our lives easy and think about us as single people right now. You take your total income, let's say you earn 100,000, You look at your W-2 document and it'll show you how much are you saving already into maybe a 401k or a simple plan or whatever. And you subtract that information. You subtract whatever you owe in federal taxes for a given year. And you subtract those finite liabilities. Again, the kids, their gymnastics, the diabetes medicine for your dog that's already 12 years old, that dog's not going to make it to retirement, right? Car loans, etc. Things that you know you're going to pay off, right? And then once those things that you're going to pay off that are not going to follow you into retirement. Now I have car loan in here, but if you're the kind of person that enjoys having a fresh new car every few years and you pretty much always have a car note, then don't delete that because you need to know that that's part of your personal spending. And this number that we come up with is your actual spending. But when we go and we project it forward, the things that we have to prepare for is inflation, of course. So my, $100,000 of spending in 2026, if I look at 2046, of course it's going to be more. Like the same way that my 26 spending is way more than we were spending back in 2006, which I hate to tell you was 20 years ago. It breaks my heart to think that I was out there in the clubs and it was 20 years ago. But it's really just a mathematical fact that unfortunately we all have to face. Uh, Accounting for longevity, this means how long are you going to live? God knows, right? None of us know this. But what we do know is that at 94 years old, you're probably not going to go back out and get a job. So you need to make sure that you are preparing yourself to a reasonable degree for the possibility that you're going to live to 100. The actuarial tables are going to be later in these slides, but it's a very real possibility that you're going to live a very long time, especially if you're already past like age 50. The actuarial tables are such that they say like it's a very, very strong likelihood that you've got a lot of years in front of you. So we want to be prepared for that. And then the thing about nursing care needs. Okay, so we're going to get into these as we come through these slides. But inflation in particular, I want to bring up this particular slide that shows you the inflation rate over an unspecified amount of time here because I cut it off apparently. But what I did want you to know that this goes back to the year 2000, and these are annual inflation rates, and they average out to about 3%. So when you are taking your current spending, please use at least a 3% inflation metric when you're looking towards the future. The longevity, this is where I was saying like how long you need to plan to be non-working. Right now, the US life expectancy for a female is 81.4 years. That's gone up since the last time I did this particular presentation in 2023, at which point it was 79. So there's a really cool calculator you can find on the Social Security website that I have listed at the bottom if you want to see how that is changing over time. But like I was saying, if you're already 62, yours is not 81 years. It's actually 86 years. If you're already 67, you need to plan to live to 87 as an average, right? Like this isn't everybody, but it's likely enough that you need to plan for it. And if you're already 70, you need to plan to live to at least 88.1, right? Again, these are averages. If your personal history, like you're a healthy person, you don't smoke, you exercise, you don't love chicken nuggets as much as I do, you probably need to plan for a longer life expectancy. Same thing if there is longevity in your family. My grandmother is 89 years old. She's turning 90 in July. She is the Energizer Bunny. She was depressed this last fall when she told me that she no longer is walking the course when she goes golfing with her girlfriends, that she has to ride in the cart. This was a major slowdown for her. And she's pushing 90, right? Um, Meanwhile, there's other folks where they have a lot of relatives, especially female relatives, that maybe have not lived to 100. They maybe have history of cancer or other things in their family where the the likelihood of them living past 88 is not as strong. And so, everybody's different, is my point. The long term care needs, I mean, this is one of those depressing things, but we all know this, that 71% of the people living in assisted living are women. Um, and the grim statistic is, think about how many wives are younger than their husbands. So, what happens there in most scenarios that I see with my clients is that the husband is older and men are sicker, like they just die younger, right? And so he gets ill, but let's say he's 80, she's 75, she's still in great shape. She takes care of him for 3 or 4 years. He passes away at 84. Now she's 79 and she's not as in good a shape as she was younger, but also she's worn out because she's been taking care of him. And there's nobody left to take care of her. And so that happens very frequently. If he's alive, according to the Journal for Age and Aging, he doesn't help. Like, men are just not as likely, especially if they are already over 70 now. Like, it's just a generational thing that they're not as likely to have caring skills. If you have a husband or a spouse or a partner who is good at these things, you have a lovely person at your house, and I'm so happy for you. But a lot of folks, this is just one of those things that we've all accepted, that like it's not as normal for men to be good at taking care of people or even just taking care of the basics. Like, if you had asked my father-in-law where they buy groceries, or like what's the cost of a banana, it can't be more than $10. Do you remember that Arrested Development quote? What's a banana cost? It can't be more than $10. Like, this is the kind of out of touch thing that a lot of older spouses have when one of the spouses has done all of the caring for the family. And it doesn't have to be gendered, but I mean, to be realistic, Frank, usually it is, right? So, being prepared to need some sort of nursing care late in life, as an above and beyond to just your standard budget. But the less grim part is that I want us to plan by decade, or by 10-year chunks. Let's put it that way. And I don't mean like, your 70s. I mean, if you are currently quitting work and you're already 72 and you're in great shape, you need to assume that for the next 10 years, you want to do stuff. You want to have fun. You're probably going to spend more. And at the end of that first 10 years, you will have probably done some of those bucket list trips. And you have probably done the big gifting to your favorite charity or your grandkids or whatever it might be. And that's going to slow down. The same thing if you quit working at 55. For that next 10 years, you're probably going to really have a lot of pent up desires to do travel or crafting or whatever it is for you that is going to be more expensive. And so I wanted to kind of just bring that into our conversation, that having social goals and being active and doing stuff is what keeps us alive longer. But having family goals, like I'm going to leave my children $1 million each when I die, or it's very important to me to leave a big trust fund for my great grandkids, those things are not as commonly reported as something that brings satisfaction to those folks who have reached financial independence. So that's a little bit convoluted, but the general point is living your life and having fun has been reported to give people more satisfaction than family goals of, I will have great grandkids and I will live to see those great grandkids all go to Stanford on my dime. That kind of stuff is not as common. So, wanted to draw that to your attention when we're thinking about what we want to do with ourselves after we quit paid work, which again is a euphemism for retirement, but it's because I wanted to make it more inclusive. So, into the logistics. Here's the boring stuff, right? when we're trying to figure out how am I going to make ends meet post paid work, what do I need? So gather up your income sources. Go on the Social Security website, ssa.gov, pull the estimate for your particular track record, your work record, and find out what your benefit is. You're going to need to find any pension estimates that you might have from working for the state or for the city of Boston or any of the other places that still have a pension. They're few and far between these days, but also the ongoing income. So, for example, if you have rental property or if you have some oil royalties that you have received over the years, those income streams will probably continue well into your independence years. And then don't dismiss the idea of an inheritance if it's just absolutely cut and dry that you will receive an inheritance, right? Like we all want to plan for the worst, hope for the best. But if you are 70 and your parents are in their late 90s and they still have a house and a couple $1 million, the chances of them spending all of that is very unlikely. So you have to be realistic. You don't want to be the grasshopper in this, analogy of the ant and the grasshopper. You don't want to while away your days and plan nothing, but you also just want to make sure that you're being realistic, that there probably will be an inheritance for a lot of folks, and being smart about understanding what you will be getting from other family members or other loved ones and how the taxes of that stuff works is just like smarter to be prepared. Okay. Going back to the Social Security estimates, sometimes a lot of folks will ask me, "Well, but I thought Social Security was going bankrupt. Why would I rely on the Social Security website answers?" Um, the reason that I would include Social Security in your planning is multiple reasons. Number one, the Social Security trust is it's an accounting construct. If the government wanted to fund it, they would. Like it doesn't have to completely disappear. But then secondly, I want to remind everybody that the trust that they talk about when they talk about bankruptcy of the Social Security system, that part is 1/3 of the payments that are going out to baby boomers, and 2/3 of the payments that are going out are coming from payroll withholding. So everybody who's currently working and is doing paycheck deferral into FICA, that money is what's paying for 2/3 of the current benefits that are being paid out. So if anything, I would subtract 33% from the number you find on the Social Security website, and that's going to be plenty conservative, in my opinion. Your mileage may vary on that, but that is my opinion. You're still giving yourself that discount, but you're being realistic that I don't think the system can go completely bankrupt. Um, this especially because for those of us in Gen X or the millennial generation, I personally am literally the crux of those two things, being born in 1980. I am the end of the Gen X. I am the beginning of the millennials. I am just everybody's favorite person, because the next largest cohort is younger than us. And so the chances of the baby boomers passing away eventually and and reducing the stress on the social security system as the younger folks are coming into their highest paid years is very likely. The same way that, at least in my small town, the elementary school I went to was built in like 1951 because there were so many baby boomers going into elementary school back then. And then in the 80s, when I went to school there, it was super old. Well, the same thing's going to happen in the future, in my opinion, with a lot of the other systems that are under more stress now than I think they will be as time goes on. Okay. The other thing about assets. Oh, wait, I have to go back one thing regarding those pension estimates. The only thing about pension estimates that I really want to point out is yes, they are very important. They are something that you will receive. But please remember that although Social Security has a cost of living adjustment baked into it on an annual basis, pension estimates do not. There is no inflation adjustment. So if you were supposed to get $700 a month from your pension, if you were a teacher or something like that, be prepared that that number will not get bigger. And when we go back to earlier when I was talking about inflation, that's going to be a problem if you do live a long time. Inflation will really eat away at the spending power of that $700. So be prepared. Okay, assets. So a lot of folks have retirement plans kind of left behind at other jobs. So, let's say personally, I worked at Commerce Bank back in the early 2000s, and then I worked at SunTrust Bank, and then I worked at Thornburg, and then I worked at another place here in Austin. So, like, there could be old retirement plans left behind at all of these former jobs. One of the best things you can do for yourself is to gather up those retirement plans and keep them all in your current 401k. If you are a corporate person that has a 401k, you can almost all retirement plans will allow you an incoming rollover, is what they call it, where you add money to your 401k by consolidating from these other custodial banks. So, for example, if my current 401k is sitting at Fidelity, but my old 401k was at Vanguard, and when I log on to the Vanguard website, it says the SunTrust Bank 401k for the benefit of Kacie Swartz. I can take that money and I can call Vanguard and say, please send me a check so that I can put it in this account. When you do that, make sure that you do not have the check written to you personally. So I do not want that check to be written to Kacie Swartz and be for like $40,000 or $800,000 or however much you have in that old 401k. What you really want and what they should do is they write the check to Fidelity for the benefit of Kacie Swartz, or FBO, for benefit of. And that means that they are handing the custody and they are handing the responsibility of that money from Vanguard to Fidelity, but it's still to my benefit. The reason you want to do this is because if they write you the check, that is a taxable event. But if they send the money from bank to bank, it is not a taxable event. So be very, very careful about that when you are filling out the withdrawal paperwork. But it's one of those things that they will give you about 14 different disclaimer like screens, or they have to read you a script if you call. Like, they make it very, very clear, and we just want to make sure that we're being careful that that money goes into a the same style of account, a 401k or a rollover IRA, either one, and it does not go into my regular checking account, because that's what's taxable if it goes into my regular checking or my regular brokerage. It needs to go into what's called a qualified plan. A qualified plan is an IRA, which stands for individual retirement account. It's the opposite of a 401k because I own my IRA. The 401k, the company owns it. For those folks that work in education, that might be your 457 or 403b plan. If you work for the state, it might be a 457 plan. So just want you to know that there's a few different labels on those kind of retirement plans, but they're all qualified, which means that they will not create immediate taxes for you. Okay. Consolidating those plans is a great idea, because the other thing is that if, back when I worked at Commerce, I was in my early 20s. I think I had like $7,000 in that 401k when I quit there. And if I had been not an employee there for enough time, they're just like a lot of places. They're going to sell my account to one of the big warehouse distribution places like Computer Share or Millennium Trust. And then it's really hard to find because you're like, I used to work at Commerce, but Commerce's 401k is through Fidelity. And Fidelity doesn't have any record of me anymore. What happened to it? Well, then you have to go through one of those like lost money websites to try and track it down, or calling Fidelity, calling Commerce Bank to figure out where they sold your old 401k to. So my point is like just be fairly on top of it in consolidating those old retirement plans, especially if they're smaller amounts, or maybe you didn't work there for that long, so that they don't get like piled up at some warehouse and make it harder for yourself. Uh, the cost basis on taxable accounts. The reason that that's important. So remember that there's three types of taxation when we're talking about savings accounts. There's annual taxation, there's taxation when you make a withdrawal, but no taxes on an annual basis. That's those qualified accounts I was just talking about. And then the third best kind, picture lots of sparkles around it, is the Roth style, where you pay taxes up front, but then you never pay taxes again. Or to put that in another phrase, I fund my Roth account with money that I've already paid taxes on because I fund it with money from my checking account, which I've already paid federal taxes on that because it was like from my income or whatever. And so then it grows tax free forever because it was not a tax benefit in the first place. But back to the taxable accounts, the ones that we get a 1099 on every year. Like I said, it's March of 26 right now. Most of us have all of those 1099s sitting around, like the one I have from RBFCU, where it says I earned like $12 last year. Actually, I think it has to be more than 15 for them to send you a 1099. So let's say I earned like $22. My point is that I have to report that income every single year on my taxes. And the same is true of my Fidelity brokerage account, not a rollover IRA, not a qualified account, not a Roth account, but just regular old Kacie Swartz brokerage account. I have to report the dividends, interest, and capital gains that that particular account throws off on an annual basis. Well, capital gains are a tax that is a different metric than our regular ordinary income taxes. Like when you look at your tax bracket, that's different than capital gains, is where I'm going with this. And you need to know what the cost basis is, because cost basis is the initial purchase price. So, for example, if I own 15 shares of NVIDIA and I bought it when it cost $30 a share, and now it's trading at like $400 a share. The cost basis is the difference between 400 minus the original 30. So what is that? 370. And then adjusted if there's ever been dividends or a stock split. That $370 gain per share gets adjusted by those dividends and everything else, which is math that those banks are supposed to do for you. And since 2005, that information from those different banks that did the math for you, it's supposed to follow the securities if you ever transfer them. So if you used to have your accounts at Fidelity and you moved over to Schwab, the cost basis, if it's a covered security, the cost basis will move with it. Recently, I was talking to somebody who was at Indeed for a while, and so they have shares of Indeed, but Indeed is actually owned by a Japanese company, and so the stock is not a covered security. So the cost basis does not travel with the stock because it's actually a Japanese stock. So it's not reported the same way that US stocks are. So my point is that the IRS requires the individual to know this information. They do not get it from any other sources. So it's up to us to prove the cost basis or the beginning price that we value our growth and our capital gain, we have to prove that if we ever get audited. Okay. Especially on positions that you sell, because it only really matters when you have realized a capital gain. This is an industry word, realized. It means that you actually sold something. A lot of us have a brokerage account with an unrealized gain baked into it because it means that if I sold it, there's a lot of gain, but it won't matter unless that particular position gets sold. It's not a taxable event unless I actually sell the position. Okay. A long way to go on a fairly easy topic. If this is something you have questions on or don't understand, please do let me know. But also, Investopedia is our friend when it comes to explaining things like adjusted cost basis. The last part I've got on here is the appraisal info on your real estate. So again, when we are trying to figure out what are my resources for the future, you need to know, what does the county think this house is worth? What does the county think my rental houses are worth, et cetera, et cetera. So you just want to know those values, because maybe when you are financially independent, aka you don't have to go to your corporate job, you may not want to stay in your job, or I'm sorry, in your home. You may want to move to another state, to another neighborhood, whatever it might be. And so the assumption that you're going to sell that place is something that you need to at least know what you would get for it if that was to happen. So the same thing's going to be true when we talk about liabilities. What are the mortgage details? So if you're going to sell that property, how much are you actually going to pocket? If you have to pay off a mortgage, you have to pay off the realtor, you need to plan for that, right? The other liabilities are things like education funding if needed. This means if you plan to pay for your kids' college, you need to plan for that the in the future planning of what are the dollars that are going to be available for me if I spend my money on this kid. Um, Everybody has a different philosophy about paying for college. Your decisions are yours. However, I will just remind you that there is no student loan for retirement. There is no way to get more assets if you are 85 years old. You're probably not going to work. So, education funding certainly can be paying out of pocket for college, but I would really encourage everyone to look at the different ways to use credit or grants or whatever for that education. And then feel free to help the kids pay it off, but uh, do not assume that you're going to like mortgage your own future just to make sure that those kids can go to college for free, in my opinion. The age and place renovation. So this is one of those things that I really, really like, because it is so much easier to make thoughtful, considered choices about how to make your living space comfortable to age in place if you're doing it 20 years before it needs to be used, or even 10 years before it needs to be used. If I was to look at my current home, and I'm like, okay, I'm going to be financially independent in 10 years, and therefore I won't have the same salary I have now, but what if I needed a roll in shower, or even just a bathroom that I could get a wheelchair into? I would definitely need to make renovations, because I have a house from the 60s that does not have wide doorways. It has those older tubs with the giant lip on the side so that you can have a bath in them. I mean, I love that, but it's not a place that would be very convenient to age in place. Same thing for folks that have their bedrooms on the second level, or their kitchen needs to be changed. One of the weirdest things that I bring up when I talk to folks about this is that when you get older, it gets really hard to get stuff out of the upper cabinets. And so this is one of those age in place renovations that's pretty low effort but huge results, which is, with your lower cabinets, put in those slide out drawers so that you can like pull out the drawer from your lower cabinet and reach stuff in the back. This is huge. And it was huge for my mother-in-law. She was a very short woman. And so she never had a very good reach into the upper cabinets. But when she got into her 80s, she also lost a lot of the strength in her arms. And so she couldn't put anything heavy up. And by heavy, I mean like a casserole dish. She couldn't do that. And so this is where I'm saying, like, make it really easy on yourself to lean over and do something like putting in those pull-out drawers in your lower cabinets is is an age in place renovation that we may not think about, right? Same thing with like if you need to make changes to like a handrail outside that goes into your garage and it's getting older and it's like falling apart. Like, do these things before they need to be done so that um, you don't have that added anxiety of somebody in your life, in your family, having a major health event, like um, you know, not being as mobile as they are now, on top of trying to get those things fixed. So that's my encouragement there, especially if you're thinking this is a house I want to age in. If you're thinking this is a house I'm going to sell and I'm not going to stay here, then just think of these as recommendations for what to look for, right? Okay, next topic. So, uh I'm a financial planner, which means that I focus on all of the multiple facets of your financial life. Sometimes that means that I don't focus on investments as much as a lot of the people who are seeking out the Austin Women's Investing Group. But that's because I love control. I have a type A personality. I love to tell people what to do. If you've made it this far into the video, I appreciate you listening to me. You are better than a lot of the people in my life, including my children. Um, but the reason I focus on all of those control elements is because returns are fantastic in your portfolio. I love a good return as well, but if you're getting a 6% return on a portfolio that you had only put $100,000 into when you were saving, like that is not going to do it for your future. So that's why I like to be proactive and I like to really focus on tax efficiency and saving strategies and getting the most out of your corporate overlords so that you are not over relying on a portfolio that's way out on this efficient frontier in the top right quadrant and not giving you the same kind of return for the level of risk that you're taking on. Okay, so that's where I'm going with this. And remember that the S&P 500, the 500 largest companies in the United States, which gets reconstituted every year, and maybe the number one largest is Apple and the number two is Nvidia or whatever, whatever. But 30 years ago, that wasn't the same, right? Or maybe it was longer than that. But my point is, like at one point, it was General Electric and Western Union. And, my point is that that reconstitution means that the S&P 500 is always reflecting the biggest companies in the US, and those companies are about 80% of the US economy and therefore about 60% of the world economy. Again, as of March 2026, it really feels like the world's changing at the moment. So those numbers are probably not accurate if you're listening to this in the future. But it's still a very large diversification across the world economy, is my point. And the S&P 500 in particular has a very long track record in recorded financial history. And there is a very strong recurring theme of an average 10% return on an all stock S&P 500 investment mix, especially if you include the dividends reinvested. If you don't reinvest the dividends, don't expect a 10% average return. But my point is, like, 10% is probably on the high side of what you can expect on a long term basis. And so what we're looking at here is using that 6% return for a blended portfolio. I just want to really indicate to folks that this is what it would look like if you start with 500,000 and you either put in zero on the far left, if you put $6,500 in every year on the middle, and if you were to put 18,000 in on the far right. The future value, the dollar amount at the bottom, is so much larger by just making an annual contribution. So again, because I have the benefit of sitting here and redoing this webinar, I can tell you that the top PV, that stands for present value. If you're a long time AWIG person, then you have probably seen Sarah go through the time value of money multiple times. But for those who may not have seen it, I want you to know that time value of money is how we find the future value of today's investment, including in, which is number of years. This is 20 years. I stands for the investment rate, the 6%. Payment, PMT, that's the 6,500 in the middle, the 6,500 plus 12,000 on the right, and then future value. It takes all of that math and it projects it forward. And so my point is that by just putting that 18,000, if you did 6,500 into let's say a Roth account, and then you did 1,000 a month into some sort of other savings, that's the far right. That's the 18,500 total. Your 500,000 is definitely going to grow at a much faster rate because you are investing across market cycles of that 20 years, and you have given more fuel to your portfolio's growth. The note at the bottom about increased savings reducing your lifestyle creep. This is because for most of us, as our income goes up, so does our spending. That's natural. And I'm not saying you shouldn't do that, but I am saying if you can mitigate it to a certain degree by paying yourself first, and by paying yourself first, that means increase your 401k contribution so that the money hitting your checking account is money that you can spend without feeling like you have stolen from your future. And it will reduce the creep because you're not going to have as much in your pocket. You're still going to have more, which is good. But also you're going to meet those savings goals, and you're also going to feel better about the money you do spend. The next thing I want to remind everybody is about staying invested. This is super timely because, again, I'm sitting here in March of 2026. We're at war with Iran. The European Union is not trading with us at the moment. Like, China is buying up all sorts of space in South America. Like, there's always something new on the headlines, on the Wall Street Journal, on the news, whatever it is. There's always something new to be scared of and to say, I really need to get out of the market before this breaks bad. Well, this timeline is to show you the fat white line across the middle where it goes up over a long-term linear number, but there's plenty of dips in it. That's to show you across all of these different headlines how your portfolio would have grown if you had stayed invested. And it's really hard to do because the the geometry of the stock market is such that the stock market is always expanding. You will participate in that if you stay invested. The market dips below that string, that yellow string across the middle, because of surprises. And it's not going to be a surprise unless it's a new thing that we've never seen before, right? And so if you are here in 2016, you're going to see the China slowdown. You're going to see the like 2 days that the market went down when Trump got elected. In March of 2020, you're going to see this dip when COVID was new and we shut down everything. But within 3 months, the markets had recovered. 2020 was one of the best returns on record. So my point is that you should stay invested with your dollars that are for the future. That doesn't mean that you should ignore your cash needs in your short term. And so that's where I say have a buffer. Markets can't do it all. You have to be safe. You have to save. You have to be tax efficient. I completely want to send that thought home with everybody. The having a buffer is all about having cash on hand and investments that are not the stock market so that you feel safer and um, more confident in keeping the equities in your portfolio during dips because you know you have all the other dollars. And again, that's something that really only works if you've planned ahead. If you are sitting in retirement with a 100% stock portfolio and the market's starting to dip, you don't have any options. You have to sell something at a loss or at a less than ideal price because you're not planning ahead. And having a buffer on the amount of expenses you need is also important. One of the things that when I was doing my I need a budget work, and I was always coming up with like this random, let's say $20,000 roughly, that every single year I would be spending on some new issue. So there was the year that my husband needed a dental implant. There was the year that we had prepared for IVF, but we needed more drugs than we anticipated, and it was an additional 20,000. There was the year that we were having a baby. We were thrilled. We were so excited. We had planned for this. But then our cast iron plumbing at our old 1960s house went down like a month before she was born. And my husband had a serious nesting situation and decided that we had to get it fixed before she was born, which I don't disagree with. But guess what it cost? $20,000, right? Um, and then this year, the 20,000 is probably going to be that we're going to need a new car. My point is that there's always something. So have a buffer because unexpected expenses should be expected. We never know what they're going to be, but we know it's going to be something. Focus on the quality of your life. So when you're thinking about the future, I hate the idea that you're moving toward financial independence because you hate where you are now. I want you to move towards financial independence because you're moving towards something that you like better than where you are now. Moving towards something that's more fulfilling or more restful or something that you're excited about. I think that that's what keeps us engaged and keeps us pushing. And that has to continue post paid work. You have to find things that make your week worth living so that you enjoy all of that savings that you've done. And then running your own race. I mean, I know it says limit your lifestyle creep, don't let FOMO ruin your future. That's fear of missing out, just in case that's not a acronym that people use in the future. But my point is that running our own race means that we don't compare our spending and our savings to our friends and or TikTok influencers because number one, they're not telling the truth. Like they just aren't. I'm people's financial planner. I can tell you nobody's telling the truth. But also because what's it called? Comparison is the thief of joy. Like you have to focus on what makes you happy. And so for example, one of the big things that a lot of people talk about with retirement is travel. I want to travel. I want to see the world. I love travel. But I get a decent amount of folks that are in my office and they're saying, I hate travel. I don't want to travel. I want to sit quietly at home. I want to volunteer at the library. I want to pet my cat and I want to not have to work. Okay, that's totally a reasonable future. So run your own race and enjoy it and forget about like what other people say is like the 10 places you have to see before you die. Maybe that's accurate for you, but maybe it's not. And I'm going to leave you with one of my favorite quotes from Downton Abbey that was a picture taken from one dinner, I think in the first season, when she's meeting Cousin Matthew. If anybody didn't watch Downton Abbey, this is a dowager countess. She is the older generation, of course. And This is the like 1910s or something like that. She had never heard the word weekend. So she asks at the dinner table, what is a weekend? Because in her life, there was no difference on a Saturday and Sunday. And I want that for all of us. So one of the stories that I like to tell is my other grandmother, not the 90-year-old lady, but the other one, was retired and she was failing a little bit. So she was at the emergency room. And when you're at the emergency room and you've been brought in from a nursing facility, one of the things they ask you is, Wanda, which her name was Wanda, right? They don't ask everybody for that. But her name was Wanda. So they said, Wanda, do you know what day it is? And Wanda said, what do I care? Because she was retired. She did not care. That is the future I want for all of us. Last things, questions you would like to ask in private. This is my contact information. I do hope that you have found today's presentation useful. My apologies again for messing up the recording at the meeting, but hopefully the audio here was more precise and better, and I really appreciate your time. Thank you for joining me. Have a great day.